Let me give you the most straightforward breakdown of Index Universal Life you've probably ever heard. By the end of this, you'll understand how it works, why people use it, and what actually happens behind the scenes. First, we have to start with the basics of life insurance. In the insurance world, everything falls into one of two camps. You have term life insurance and you have permanent life insurance. Let's start with term. Term is the simplest form of coverage. It protects you for a set period, usually 10, 20, or 30 years. There's no savings, no investment component, no cash value. It is strictly a death benefit. If you pass away during that window, your policy pays your beneficiary. When the term expires, it's done. You either renew, usually at a higher price, or you apply for new coverage. Because it's temporary and pure insurance, the pricing is low and it's easy to understand. Permanent insurance, however, is designed for lifetime protection. It doesn't expire at 60 or 70. It stays with you. And unlike term, permanent life insurance builds cash value. Money inside the policy that grows over time and can be accessed while you're still alive. Within permanent insurance, there are multiple variations. The one we're going to be focused on today is called Indexed Universal Life, or IUL for short. And just so that we're crystal clear, IUL is not whole life. People confuse them constantly, but they work differently. Credit interests differently and are built for different goals. IUL has been in the marketplace since the late 1990s, the same era the Roth IRA appeared. And because both have attractive tax advantages, people love to compare them. But a Roth is a retirement account and IUL is an insurance contract. Two different frameworks. So let me show you how an IUL actually works. Everything starts with a premium or your payment. You can pay monthly, quarterly, semi-annually, or once a year. When the insurance company receives that payment, the first thing they do is deduct the cost of insurance and any policy charges. Insurance is a product. It isn't free. Whatever remains after expenses is allocated to your cash value. Think of cash value like a bucket inside of your policy. Interest is earned, it compounds, and over time, it can become a pool of money that you can use. The longer you leave it to grow, the stronger the compounding effect becomes. Inside an IUL, the goal of the cash value is to capture a portion of the market's upside while eliminating market downside. To do that, IULs typically offer two crediting options. The first one is a fixed account. This grows at a guaranteed rate, predictable, steady, conservative. If the fixed rate is 3%, you're getting 3% a year. There's nothing tied to the market. Index crediting, this option tracks the performance of a market index, often the S&P 500. You're not investing in the stock market, you are tracking the index movement. If the index rises, you receive interest, but only up to a cap. If the cap is 10% and the index returns 7%, you may be credited 7%. If the index returns 20%, you do not get 20%. You are capped at 10%. Now here's the trade-off. Even if the index finishes negative, zero growth is credited. You do not receive a negative interest credit. Your cash value doesn't drop because the market dropped. That 0% floor is your downside protection. You either earn a positive number or zero, never negative. Your gains also lock in each crediting period, so prior growth isn't erased by the next bad year. This is where people start asking, how can an insurance company give me upside in good markets, but not punish me in bad markets? That sounds too good to be real. So here's what's happening behind the scenes. Insurance companies use option contracts to hedge and participate in upward market movement. An option gives you the right, not the obligation, to buy something in the future at a predetermined price. So if the market moves in your favor, you exercise that option and take the profit. If it doesn't, you let the option expire, and your loss is limited to the cost of that option. So let me make that real. Imagine the house is worth $300K today. Instead of buying it now, you pay $5,000 for a one-year option to buy it later at today's price. If a year passes and that house is now worth $400,000, you lock in a huge gain by buying at the lower price. However, if the house drops to $200K, you simply walk away. You're out the $5K, but you didn't lose the $100K. That's how options work. Controlled upside, limited downside. That's the same approach insurance companies use. But here's the key. They're not using your principal cash value to buy options. Your money sits in the insurer's general account, earning a steady internal rate, for example, 3%. The insurance company uses that interest generated from that general account to purchase options. If the options pays off, you get index credits. If they expire worthless, your credit is zero, but your cash value is still intact. That's how they can say no market loss, locked in gains, capped upside, zero floor. It's financial engineering using option pricing. Let's talk about designing an IUL according to your goals. So there is no one best design. It depends on what you care about. Some people want the largest permanent death benefit possible for generational planning, estate transfers, or protecting income. In that case, the policy is structured to maximize coverage while keeping premiums manageable and ensuring the policy doesn't lapse. When someone goes this route, they still have cash value. It's just not the primary objective. Others want maximum cash accumulation for retirement income, college planning, business capital, tax-free distributions, whatever it is. In that case, the strategy flips. You drop the death benefit to the lowest amount the IRS allows, minimizing insurance costs. Push more of each dollar into cash value. This is what people mean when they say properly structured IUL. But there's a guardrail. Lower the death benefit too far and you cross into MEC status, which is modified endowment contract, and you lose the tax advantages. Now loans can become taxable. That defeats the purpose completely. This is why people say a good IUL is based on structure, not sales pitch. Now, how do you access the cash value? So there are two core methods. The first one is withdrawals. Straight subtraction from the policy. Anything above your cost basis becomes taxable. Because of that tax issue, withdrawals aren't the preferred method. The second one is policy loans. This is where the magic is. When you take a policy loan, you are borrowing from the insurance company using your cash value as collateral. Because a loan isn't considered income, it's not taxed. Your collateral stays in the policy earning interest depending on your crediting choices. Loans come in two forms. Fixed loans, where the company moves the borrowed portion into a fixed bucket, maybe 3%, and charges you roughly the same interest. That creates a wash loan. No spread, low volatility. Or you have an index or variable loan. You may pay a higher loan interest rate, maybe 5%, but the portion you borrowed against stays in the index strategy. And if the index earns 7% and you're paying 5% for the loan, you're net positive by 2%. That's arbitrage. That's why some people use IULs for retirement income and controlled leverage. However, if the index earns 0% and you're paying 5%, then you have a negative spread that year. So it's risk and reward. It's up to you. Most carriers allow you to switch loan types annually, so nothing is permanent. And IUL loans are flexible. There's no mandatory monthly repayment. You control the timing. And if you die with a loan, the carrier subtracts it from the death benefit and pays the rest tax-free. Now, there's also living benefits. Most modern IULs provide living benefits, meaning you can accelerate part of your death benefit if you're diagnosed with chronic illness, critical illness, terminal illness, sometimes long-term care triggers. That's money while you're still alive on your terms. Now, the downsides you should know up front. IUL isn't perfect and shouldn't be positioned as magic. It costs more than term because it's permanent and carries cash value. Flatter down market years can mean 0% credit. Returns aren't guaranteed. They vary with caps, volatility, and interest conditions. Caps can move depending on economic conditions. And the policy requires proper funding. Underfunding can drag performance, and bad design can make a policy. And to be honest, some agents chase commissions over structure. That's why conservative illustrations matter. Run numbers based on realistic assumptions. Don't assume double-digit returns every year. Strong years should be a bonus, not a requirement. So my final perspective, IUL sit between aggressive investing and conservative savings. You're not risking principal like the stock market. You're not earning bank account peanuts. You're capturing a slice of market upside with downside protection and tax advantage access. For the right person, long-term thinker, disciplined funder, someone who values tax strategy and flexibility, it can be a powerful tool. For someone looking for get-rich-quick outcomes or someone unwilling to fund it properly, it's simply the wrong product. But now you understand the mechanics, the why, the how, and the realistic expectations. That was the goal. So I hope you find value in this. And if you have any questions, the link is below in the bio. Please reach out to me. I look forward to talking to you guys. It was a pleasure.